right. Well, thank you everyone for tuning in to another quarterly update from Mark and I here at Tower Asset Management. And we're going to jump right in. And we're going to start by talking inflation.
Hang on a second. What is that? What's with the background? You look beautiful there, Tarek.
You like that, huh? That's not bad. That's not bad.
Beautiful blue triangle.
Can't even point to it because I disappear behind it. But yeah, there you go.
Your fingers have to
yeah, it gets cut off.
All right, I guess we better get to work.
Yes, absolutely. You know, it's funny. Inflation and interest rates seems to be something we have to bring up every single quarter because that seems to be what's driving the conversation in capital markets. And it's a little bit better news this time around. So in the U.S. and Canada, in the U.S., inflation at the end of March was 5.6% year over year, which is still well above the target, but it's declining. So it was a little higher in February. It's moving in the right direction. So that's a good thing. In Canada, similar story. Our numbers are up to February, not quite to March yet, but it was 5.2% year over year, still well above what we needed to be, but on the decline. So that's a good thing. Central banks are happy. In fact, we're recording this the day after the Bank of Canada said no more. We're not doing another rate increase at this time. So that's huge. The Fed also chose not to do a rate increase at their last meeting too. So that, after going, I think over 4% in rate increases last year in Canada, to have a pause is a nice relief for. But
you said central banks are happy, but I think we've got a story or two about banks going under. You better go there.
Oh, that's a good point. And that's a lot of the reason why, it's kind of bearing the lead to say it's because inflation's under control, because it's not. The reason banks, or at least the U.S. Federal Reserve, slowed down is because of, if you don't have a television or haven't looked at a newspaper in the last 3 months, there's a number of very prominent bank failures and bank troubles over the last couple of months. Right. So it started with the Signature Valley Bank out of San Francisco. This is a bank that primarily focused on tech entrepreneurs because of its location in San Francisco. And a Signature Bank that failed, and then a lot of good old fashioned bank runs.
So is that two, Silicon Valley and Signature Bank?
Yes, those are two. Now, Signature Bank was heavily attached to the crypto industry, which we know, really, really blew up in 2022. And so, and we won't get into the specifics of what happened with Silicon Valley Bank. It's an interesting one. The depositors ended up being made whole. So the shareholders lost, and the owners of the bank, or the equity holders of the bank, lost the money, but the actual depositors didn't, which is probably a good thing.
And then Credit Suisse was taken over by UBS.
That's right, Credit Suisse. I mean, you think banking, you think Swiss bank, and this is supposed to be creme de la creme, good bank. They've been having trouble for a little while, but this is a couple 100-year-old or over 100-year-old institution being forced to be taken over by their biggest rival, UBS, another Swiss bank. And I think Credit Suisse was on the too big to fail list, right? Which is why regulators had to jump in. And people were jittery.
So Tarek, you got me worried. One, what are our numbers? Let's make that item number 2. Let me go with item number 1, and that is, I found this list, and I sent it to you, so you've seen it earlier.
I got it right in front of me right now.
And maybe we'll put it together, complete it to up to date, and send it out to all of you who are on our client list. But it's kind of humorous. 60 plus 70 excuses for not investing, something like that. However many years. Starts in 1950. There was a Korean War. Didn't want to invest in 1950 because of the Korean War. And 51, excess profits were beginning to be taxed. 52, U.S. seizes steel mills. In 1953, you didn't want to invest because Soviets explode an H-bomb. Jump forward to whatever year you like. 80, scandal rocks Congress. 81, Reagan and Pope are shot. 82, worst recession in 40 years. Doesn't matter, jump on down, pick a year. 99, of course, was fears of Y2K. You don't want to invest in that. Internet bubble bursts in 2000, terrorist attacks in the U.S. in 01. Remember 9/11?
Absolutely.
02, worst bear market. 08, massive crash. And what's the story? Should we never invest?
Oh, that's
the answer.
That's the
question. Answer. I'll go there, and then Tarek, I'll wind you up for talking about our returns. The answer is All of those events create opportunities. That's number one. And number two, not investing forgets to recognize, I'll say, the God-given genius of humanity. Humans will identify the problems, find solutions, and figure out how to make things better. There are companies that will go under, and forgive me, well, they should. Companies should go out of business. They should be taken off the stock exchange. They don't belong there. But that's part of why the market continues to go up, because humanity has this gene called creation, creativity, ingenuity, resolution of problems. That's why stocks go up over time, any year, especially in bad news years. And you just gave us a whole lot of bad news this year. I mean, COVID in 2020, like, come on, how bad is it going to get? And none of us knew. And of course, those turned out to be opportunity years for different parts of the market. And overall, the market's done really well. Okay, how do we do Q1?
Q1, and even this just highlights the difference between it. There's always something bad going on. The financial press is a short-term machine. It needs to have headlines, and there is always headlines. But the reality is oftentimes very, very different. And so if all you did was watch the news this last quarter, you think, wow, it must have been a real nosedive in the quarter because banks were going out of business, old banks that shouldn't be going out of business. But it was actually not that. It was a strong start to 2023. So if we look at our modest balanced portfolio, that's 50% equities, 50% fixed income. We were looking at 2.1% on the quarter. We go up to growth, that's 65% equities, 35% fixed income. We're up to 2.3, and then aggressive growth 2.4.
Okay, so strong 2 to 2.5% interest return in a quarter. So that would annualize out to be about 10% in a year if we did that quarter after quarter. And that's quite a safe, conservative portfolio. Okay, go ahead.
Yeah, absolutely. Well diversified, very safe. Now, the real return on...
How did the market do? How did the TSX do, which is not as safe as our diversified portfolio, but how did the TSX do in Q1?
Q1 TSX at 3.7%.
Okay. US market? Okay.
The U.S. market, the S&P 500, that's the 500 biggest companies on the U.S. stock exchange, it did 7%.
Wow. Okay.
Right? And so that's really something to be aware of, is that despite all this bad news, markets started the year out very strong, just sort of shrugged off some of that bad news in February and March and just kept trucking. And so a real good example of why invest now, don't always worry about what the financial press is saying. But if we move on to our Canadian momentum portfolio, and that's
pardon me, let me do this, Tarek. So we underperformed the TSX and the S&P 500.
That's right.
We need to identify that, to be honest, and probably in our value diversified portfolio. Yep. And you would say that is because what?
Well, I think I would say that's just the way it goes sometimes in the quarter to quarter basis. If you look at how our portfolios did on a 12-month basis compared to the S&P 500, it would be a substantially better number because the S&P was down 20% in 2022. And so they're just getting some momentum back. But that doesn't necessarily speak to the larger or longer term picture, right?
And ours was diversified, holding some equity and debt, which would be considered a more diversified, better.
Okay. Yeah, as opposed to all equities in the S&P 500, right?
Okay, keep going.
But moving on to our Canadian momentum portfolio, and this is our flagship one that we're very, very happy with. And I'm just really happy to say that we did 9.8% in one quarter on our momentum strategy. Anybody in that strategy knows we're trying to beat the TSX, and so that's more than double what the TSX did on that quarter.
Remind me, the TSX did
3.7 total return. If you include dividends, is 4.6, but 3.7 on sort of the reported index. Yeah.
And we did
9.8.
I just want to hear that again.
Yeah, 9.8.
Oh, right.
Yeah, we're extremely thrilled about that. It's a good strategy. It works, and that's coming off of 2022, where we outperformed the year by probably 7 or 8%. And so then this keep on trucking in Q1 2023, and solid double the index in the quarter performance type of situation here.
Okay, so if we were to bring this home to each of you who are investors with us, we would like to say this. We have been sort of beating the drum on our momentum. It does seem to work. It is purely mathematical. We built 3 screens, whatever makes it through the 3 screens. Those are the 12 stocks that we hold. Some of you, that's all you own of when you've got of the money that you have with us, it's the only thing you've got. Others of you have a piece of it within your portfolio. Others of you don't have any momentum at all. We've said this before, we say it again. We would really like to have you consider having a little bit of momentum, maybe a third, depending on your own ability to, sort of take that risk and
Your circumstances and things like
yeah,
that. Yeah,
it's suitability. That's, our compliance officer won't pass this video if we don't cite our compliance officer in the fact that, one, past returns are not a promise of future returns, and
exactly.
nothing guaranteeing that these are still going to go up. But the momentum is a lovely diversification to the value strategy that we've got working. Both of them, they're completely different. They work well together, and we would like to have you consider having a little bit of momentum in your portfolio.
Absolutely.
I think we're done.
I think so as well. That's the summary of the quarter. Thank you all for tuning in, and we look forward to chatting with you soon. Oh, one thing I should mention. For clients in and around the Medicine Hat area, we are planning to do a client appreciation in June. Tentatively, the date is June 14th. That's a Wednesday at the Cypress Club. Keep an eye out for a formal invitation in the next few weeks.
Yeah, it's worth the trip from Toronto for those of you who are, a little bit further afield. Come on out. We'd like to buy you a drink.
There you go. Perfect. All right, Mark. Appreciate it. We'll talk to everybody later.
Talk to you all. Bye-bye.